Okay, there's a couple of things I wanted to go over, and that is, I want to talk about entering transactions the way we've done it at the very beginning. We will change the way we do that in the next chapter, but also finding missing items, missing numbers in the problems. Those have been there's been some confusion there. These assignments are supposed to be opening up to the book, and some students are reporting that they are not. So if you can't actually open those assignments and actually read the book, go to the McGraw-Hill Connect navigation tool, and then go to your Connect section. And I'm going to look at it as a student here. And if you go down here, you should be able to launch the ebook. Just click on that link right there, and you should launch the ebook. And I'm going to be on page 10 today, is where I'm going to be starting. So we'll start there. I think it's important to begin with an understanding of what we're looking at. And so let's define assets, liabilities, and equity. And page 10 has some good definitions. Assets are resources that a company owns or controls. They expect to yield future benefits. Assets include cash, supplies, equipment, land, accounts receivable. And a receivable is an asset that promises a future inflow of resources, which is a long way of saying it's something we expect to receive in the future. It's an asset that is going to be going to come to us in the way of a payment, usually in the future. It has value today. I could sell my receivables to someone, so it has value in its own right. But when it comes in, the receivable goes away and the asset comes in. For example, I have accounts receivable. Somebody owes me money. When they pay me, the accounts receivable is reduced by the amount they pay me, and cash is increased by the amount they pay me. Liabilities are claims on assets by creditors, people we've borrowed money from. And these are obligations we have to provide assets. A receivable is an obligation somebody else has to provide assets to us, pay cash basically. Other people have claims on our assets, and we have to provide assets to them. If we can't pay them, then they can take other assets, but let's try to pay them. Usually we have to provide a payment of cash. Sometimes we have an obligation to provide a future service or provide a product in the future, and those would be deferred revenue or unearned revenue, and those are liabilities. Wages payable to workers, accounts payable to suppliers, notes or loans payable to banks, and taxes and other things that are payable. And equity is the owner's claim on the assets after the liabilities have been paid. So we have the assets, creditors have a claim on some of them, and what's left after the creditors get paid, that is the equity that the owners have. That is the amount of ownership the owners have in those assets. And it's called net assets or residual equity. The accounting equation looks like this. Assets equals liabilities plus equity. And equity is contributed capital plus retained earnings. And retained earnings can be broken down into the revenues and expenses revenues we've earned and expenses we've incurred. That's net income. And dividends are distributions of those earnings to the stockholders. So assets equals liabilities plus common stock minus dividends plus revenues minus expenses. Here's a good synopsis of those elements of the accounting equation. In equity, common stock is inflows of cash and other assets from shareholders in exchange for common stock. It's called contributed capital. It reflects ownership in the company. Dividends are outflows of cash or other assets to the shareholders, and those reduce equity since we're sending assets out, usually cash. It reduces equity. Revenues increase equity through net income. from sales or for products or services, and expenses decrease equity because of net income from cost of providing those services or products to customers. So let's look at a problem and see if we can make sense of this. Here's a quick, well, it's not a quick problem. Here's a problem involving recording transactions in the way we've done it here in the very first chapter. Person invested $130,000 cash in the company in exchange for common stock. So cash goes up. We received an inflow. The company received an inflow of cash, and we issued common stock to the investor in exchange for that cash. So cash goes up. We'll put it as a positive, $130,000. You can see the balances all populate after that. And I'm going to go over here on the same line. I'm just going to tab over. Common stock also goes up by $130,000. And you can see here, here's the equal sign. So $130,000 on this side and $130,000 on this side. And I have created a couple of columns over here that add up. This adds up all the assets. This is liabilities plus equity. And they add up. Uh-oh, we didn't get another zero. They didn't balance, did they? There we go. On the 2nd of June, the company rented a furnished office and paid $6,000 cash for June's rent. Well, that should be fairly simple to figure out if we can do this. If we paid for rent, that sounds to me like an expense. The cost of providing products and services to customers. Examples are cost of employee time, use of supplies, advertising supplies, utilities, insurance fees. Rent, of course, would be in there. Taxes would be in there, whatever. So we rented a furnished office space and paid $6,000 for June's rent. So cash is going to go down. We paid $6,000 in cash. Put that in as a negative. And I'm going to go over here until I find rent expense. I put it in here. There it is. And it's already got a negative sign in front of it. I'm using it as a negative, and if we go over here, we should see that assets went down and liabilities and equity went down by $6,000. The company purchased $2,400 worth of equipment on credit, so I know cash is not going to go down. This is on credit. Cash didn't go down, but something happened. I purchased equipment, so I'm going to find equipment here, and it was $2,400. So equipment went up by $2,400. There's no other asset that was changed. I didn't give up any assets, but I did agree to pay this person in the future. So my liabilities went up. My accounts payable, this is how much I owe this guy now. And it did say, doesn't give us any information. So if it doesn't give us any other information, I'm going to the accounts payable. The company paid $1,150 cash for this month's advertising and the opening of the business. This is on the 4th. So that on the 6th, I'm sorry, on the 6th, cash went down by $1,150. We paid out cash. And advertising, that's an expense of doing business again. You go back over here. Cost of providing services, including advertising. So $1,150 in advertising expense. Can't see where, there it is. And equity goes down because an expense decreases equity. You see my balances are correct here. On June the 8th, we completed maintenance services for a customer and immediately collected $850 in cash. So we received cash. Cash goes up by $850, and this is going to be revenue. The increase of equity from sales of products or services to customers. Okay, well, we provided services maintaining their computer system for $850 in cash. I'm going to go over to the revenue side and revenue account in the equity section. It goes up by $850. My balances over here are the same. On the 14th, we completed $7,500 worth of maintenance services for City Center on credit. Again, cash is not going to go up because we did it on credit, and this is going to be a receivable. Somebody owes me money. Oops. He owes me $7,500, and we earned it by providing services. So our revenue again is going up. Revenue went up on the equity side, assets went up, cash went up on the asset side. On the 16th, we paid $800 cash for an assistant's salary for the first half of the month, so cash is going to go down by $800, and that's going to be an expense. If you look over here, an expense, employee time, that's wages, salaries. So let's go over here and find salary expense. Again, I've already got the negative in there, so it's reducing equity. On the 20th of June, the company received the payment for these services over here. Now, I've already recorded the revenue. I can't record the revenue again. I didn't earn the revenue again. I earned the revenue up here on the 14th. That's where it went in. See, if you notice on the 14th here, it went into revenue there on the 14th. Now, I can't put it in revenue again. What I did receive was the cash. So on the 20th, I received cash, $7,500 from that guy, which reduces my accounts receivable. He doesn't owe me that money anymore, and that gets me even. If you want to go out to the side and look at the balances here, you'll see that nothing happened. There was no change. This zero includes an asset that was increased and an asset that was decreased. A $7,500 increase, a $7,500 decrease. So there was no net change in either assets or equity and liabilities. On the 21st, the company completed $7,900 worth of maintenance, again, services for on credit. So we've done that before. Here it is. This is what we did over here a minute ago, where we earned $7,500 and we put it in accounts receivable and in revenue. So we're going to do the same thing. This is $7,900 in accounts receivable and $7,900 in revenue. You just want to see the balances real quick. Balances are the same. All right. On the 21st, that was the 24th, we completed $675 worth of maintenance services on credit. Again, same entry, $675 in accounts receivable, $675 in revenues. Same entry we made a minute ago. Now we received that $7,900 that we charged up here on the 21st. On the 25th of June, we received it, so cash went up, just like it did when we received the $7,500 on the 14th. No, $7,500 on the 20th. We received it. So $7,900 goes up in cash, $7,900 goes down in accounts receivable. You look at this right over here and you'll see that it's a zero transaction, but it was an up and down, an increase and a decrease in two assets. 26th of June, we made a $2,400 cash payment for the equipment we purchased on the 4th. And if you go back and look at the 4th, you want to see what you did. Equipment went up and accounts payable went up. So we're not getting any more equipment on the 26th, but our cash is going down and we're paying off that liability that we had. So assets went down and liabilities went down, and you can see it over here. On the 28th, the company paid $800 cash for an assistant's salary for the second half of the month, just like we did up here on the 16th of June. We paid $800, so that is going to be a negative to cash. It's also going to be an expense, which is wages, salary expense. Now we have $1,600 worth of expenses in this column. We've had $1,600 worth of salary expense this period. Balances are correct. Finally, not finally, but on the 29th, we paid $4,000 in cash dividends to the owners, so cash went down by $4,000, and dividends are going to be paid. They reduce equity. We'll go back again, see if I can find my thing here. Dividends are outflows of cash and assets to the shareholders, and they reduce equity. So, wow, I can't get there. You can see that the dividends, cash is decreased, and equity is decreased by the same amount. On the 30th, the company paid $150 for the monthly telephone bill. Cash went out. We paid it, and that's going to be an expense. Got to go up here and find it. It is telephone expense. Here we are. See the balance, same. And then on the 30th again, we paid another bill. We paid $890 in cash for utilities. And that gives us our final balances. This is the total of all the assets. This is the total of liabilities and equity. Now if we add up our expenses, of all the expenses at $9,790. That's my expenses. Revenue is just one account, so dividends, common stock. Let's try it again. Well, I'm just going to leave it. We're not going to fool with it. And then liabilities. Shoot. And then finally, our assets. Had a couple of assets that I didn't need. Sum of all the assets. And if we add up all the liabilities and equity, let's see what we get. Sum of all the liabilities and common stock, dividends, revenues, and expenses. Ooh, we can't add them up. We have to do it separately. Liabilities plus common stock minus dividends plus revenues minus all the expenses. $133,135, just exactly what assets are. And that's recording transactions using the method that we've done in Chapter 1.